Welcome back to Option E, where now we are going to dive deeper into really looking at different car loans. What are your options? How do you save money? Now that you guys have gotten a bit of a bigger picture with the day four activity about sort of how APR and like cash allowances and stuff work. But just as a reminder, guys, the overall goal in your life for to sort of maximize your financial everything is to have as good of a credit score as possible so you can have the lowest interest rates as possible when you want to actually buy a home and need a mortgage, or buy a car and need an auto loan, or if you just want to get a credit card. The lower your credit score, the higher the interest rates, or APR, which just stands for annual percentage rate. Interest rate and APR are the same thing when we talk about finance and loans. And the better your credit score, the higher it is, the more times you make those on-time monthly payments, you're going to have way lower interest, and you're actually going to pay less for these really big items. And we're going to start seeing just how much money you can save, first with cars, and then we'll move into homes to finish up. Okay. Just as a reminder, these are some more finance terms that we've been talking about, but if you have not done so already, make sure you put them in your math notebook. You will also be putting these in your own words in the research, your car research workbook that we were about to get into. So just as a reminder, guys, just like with the credit card unit, interest is the same thing as APR, your annual percentage rate. And that is the fees that you will be charged for borrowing money from the bank or credit card company. So that's how much extra you're getting charged on top of the cost of the car or the house or whatever it is you bought on your credit card. Interest is the fee you're charged for borrowing money from the bank or credit card. Your down payment, guys, which we'll talk about more later in today and tomorrow's lesson, is the amount of money you have saved up literally in your bank account that you show up with a check and you pay that much money up front before you get the loan. We will get into down payments to compare how that helps you or not. Loan term is the amount of time you have to pay back the loan. The three most common car loans are 36 months, 48 months, and 60 months, 3 years, 4 years, 5 years, with 12 months in each year. You can get shorter or longer in certain situations, but for this sort of weekend analysis, we're just going to focus on those three loan terms. And then finally, cash allowance, which we talked about on day 4, which is just an automatic discount the car dealership subtracts straight from the price before the down payment, before anything else. So just make sure you guys jot those down in your notebook, or you take a picture on your phone so you have these to reference. And throughout, guys, this week, our essential questions we're going to be answering is this. Why would someone choose a 36-month loan, 3 years to pay off their car, instead of 48 or 60 months? Why would someone want to choose a smaller amount of time to pay off your car? Why wouldn't you choose 60 months, 5 years to pay off your loan instead of 36 or 48 months? So by the end of this week, you guys should be able to explain to someone close to you or someone that wants to buy a car, why is it that some people like the 36 3-year loans? Why is it that some people like the 60-month, more like longer 5-year loans? Then we're also going to get into what is the benefit of a down payment? How much money do you save per month and over time with a good down payment? And then finally, how do you get the lowest possible interest rate, that lowest possible APR? Make sure, guys, that you have open, before you move on, your day 5 and day 6 notebook, where you guys are going to start doing some research and analysis on a car that you will find.